So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to continue our previous sessions on mutual funds. So in this session, we're going to talk about the long-term debt funds because in the previous session, we talked about the short-term debt funds, where we talked about the overnight funds, liquid funds, ultra short duration funds, low duration funds, and money market funds. So in this session, I'm going to talk about the long-term debt funds. The long-term debt funds are those funds which are investing a huge chunk of money into the investment securities or into the debt instruments, be it your bond or be it your debentures for more than 1 year. But in the case of the short duration funds or short term debt funds, the maximum duration or the maximum timeline was up till 1 year only. So if you are investing up till 1 year, so that's a short term debt fund. But if you are investing for more than 1 year, that's a long term debt fund. So when we talk about the long term debt fund, we have further two categories in the long term debt fund. One is the corporate bond fund, and the second is the credit risk fund. The corporate bond fund is a fund which invests more than 80% of its total assets in the corporate debt instruments with a rating of AAA and above. It means they are the highly secured instruments. And obviously, if the rating, like these ratings or the corporate ratings or the credit ratings as we call them, these are provided by the agencies called CRISIL. For example, the credit, the credit rating uh, Information Services of India Limited, or we have the CARE. CARE is the Credit Analysis and Research. And the third one we have is the ICRA, the Investment Credit and Research Agency. Okay, so you have CRISIL, you have ICRA, you have CARE. So all these three are the major credit rating agencies, like which are rating the corporate bonds and also the companies. So if a corporate bond has a rating of AA and above, be it AA plus or AAA, so it means it's a high grade investment bond, and it is like less likely to default. And it is not mandatory or not compulsory that if a bond is a uh, high grade corporate bond, it cannot default. Even the previous instances have also shown that a higher corporate bond who has a credit rating of like AAA or AA or AA plus can also default, but the probability is very less, almost equivalent to negligible. But what happens in a case of a credit risk fund? It's investing at least 65% in the bonds like which have a rating of AAA and below. Matlab, either they can be AA or B plus B, B, C. So either like C, the securities like which are below B plus, those are called the speculative securities. Like whereas the securities who are above the B plus are called the investment grade securities, and AAA are the prime securities. Whereas the securities who are like below C or like D, those are called the junk bonds. And see, like the benefit of investing in the credit risk fund is they provide you a very high rate of interest. A corporate bond fund might be giving you a rate of interest of like 9% or 10%. But in the opposite scenario, a credit risk fund will be giving you a rate of interest of like 12%, 13%, or 14%. And what is the reason for that? Because the basic rule of finance or stock market, the higher the risk, the higher is the expected return. So a large amount is being going, at least 65% of the amount, or minimum, see, it says minimum 65% of the amount is being going in the instruments which are like AA or below. So there is a higher risk. And because of the higher risk, like the more return would be provided. And the drawback is this, that they have higher risk as well. Because the securities in which these companies have invested, they might turn into bankrupt and can default, and you might not even get your money. And when I talk about the corporate bond fund, the major advantage is because they are secured because of the AA rating, and the disadvantage is they get a very less rate of return because these are kind of secured ones. And the government bonds and securities are having a lesser rate of return as compared to corporate bond funds because those are like government backed up. And the government cannot go into bankruptcy. And even if they go into bankruptcy, so like they will give you your money so that the faith is not lost in the government system or the central bank. Okay. Then they have given the example like there can be some banking and PSU funds like which invest minimum 80% of their total assets in the debt instruments of the banks, public financial institutions, and public sector undertakings and municipal bonds. Means 80% of the amount is going like towards the central and the state government projects, institutions, or companies. Then you have a guild fund. A guild fund is something which invests at least 80% into government securities. And then the government securities can be divided further into three parts. There can be your treasury bills, your treasury notes, and treasury bonds. But treasury bills are something which has a maturity of max to max 1 year. You might have heard about the 91 days T-bills or 182 days T-bills or 364 days T-bills. Then they talk about the treasury notes, like they have a maturity for 2 to 10 years or like more than 1 year, you can say. And then you have the treasury bonds, proper securities who have a maturity of 10 to 30 years. And these are open-ended. It means you can withdraw the amount. Okay. And the guild funds, it is mandatory for the provident fund companies, for pension fund companies, and the insurance companies also to invest a larger proportion into the guild funds. Okay, because they have to secure the amount in the provident fund and the insurance. Then you have the dynamic bond fund. So a dynamic bond fund is a fund that invests into the bonds with different maturities, like with different maturities. And it helps you to protect yourself from the credit risk and the interest rate risk. Like for example, like there might be like different bonds here, and the different bonds, like they might have the different durations, and on the basis of that, the interest rate impact can also be reduced. Like for example, if the interest rates are expected to rise in future, then people can invest into the short-term bonds or the present bonds that are available because the interest rates are expected to rise. So like they would be selling the long-term bonds who possess a fixed rate of interest because now it is expected to get a more rate of interest. So like they would be selling the long-term bonds which promise a fixed rate of interest, like which was quite low as compared to the interest rate which is rising in the present rate scenario. Then they would buy the short-term bonds, and when they buy the short-term bonds, the price of the bond would decline and the interest rate is rising. And ultimately on the other scenario, what happens when basically the yield or the bond yields are expected to decline, then people would be buying the long-term bonds and selling the short-term bonds, right? Because now the fixed rate of interest is being more as compared to this flexible one or the variable interest rate risk. So that is one thing. So like it depends upon the market situations. So a dynamic bond fund, it helps also to convert the long-term funds into short-term funds on the basis of the interest rate risk. And also why it is helping you to avoid the credit risk, because ultimately not all the bonds in that dynamic bond portfolio would be the AAA or single A. There might be some bonds who are double A, who are the investment grade bonds. There might be some bonds like which are the triple A, like which are the prime grade bonds. There might be some investments who are like B plus and below, who are the speculative bonds. There might be some investments who are C and D, like which are the junk bonds. So a lower grade bond can like provide you the advantage of getting a higher interest rate, but the disadvantages stands true, the risk. And the higher grade bond will help you to have a fixed rate of interest because these are like triple A or like single A, but the risk is very less, so that is good. And even you can also involve the government securities within that. So that is one thing. So that's a dynamic bond. Then you have the fixed maturity plans and you have the targeted maturity plan. Like these are the two terms of plans which we talk about in case of a fixed. So a fixed maturity plan में क्या होता है? It's a close-ended fund, and the interest rate risk is minimized here in a fixed maturity plan. But what happens in a target maturity plan? It's an open-ended fund and you can redeem your units. Whereas the interest rate risk is also very less in a target maturity plans. So these types of plans, be it the fixed maturity plans or the target maturity plans, these are the plans which are suitable for a volatile interest rate environment. And by the volatile interest rate environment, I mean because presently we do not know what India is going to do. Because in the US, we are facing a hawkish stand. And by the hawkish stand, I mean the government, like the US Fed or the Central Bank of US, is focusing towards more on inflation and less on growth and employment, because the jobless claims in the US have declined, the unemployment rate has fallen, and the growth is also there. But the main problem there is inflation, because their inflation has crossed like 7%, and that is just the reported data. In reality, it might be 10% or 12% even. So that we call it as a hawkish stand, where the governments are increasing the rate of interest, and same happened in England as well. But whereas in India, like recently the RBI, like the Honorable Governor of RBI, Mr. Shaktikanta Das, he said that he is maintaining a dovish stand. And by the dovish stand, I mean he's focusing more towards employment and growth and not on inflation, because he thinks that the rate of inflation is quite fine. Okay, so in that way, like he's maintaining a dovish stand. So it's an environment of like volatility, because we do not know that what would happen with the interest rates. In some parts of the economy, the interest rate is rising. In some part of the economy, the interest rate is constant, as in India. especially when we talk about the reverse repo rate. And some parts of the world, especially China, when they are going for the accommodative easing. And by the accommodative easing, I mean that lowering the interest rates, because recently, like, China went into a crackdown, and the economy was almost into a phase of recession. So that is where they are like lowering down the interest rate in the Asian economy. So that is something which is going on. So in such a case, if you can have a target maturity plan, so what happens in a target maturity plan or a fixed maturity plan, that you people would have a fixed maturity, a 5-year bond or a 10-year bond, and make note of one thing, that you match your investment horizon with the duration of the bond, like, so that you people can minimize the price risk and the reinvestment risk. Okay, like sometime in future, like if time permits, I would also talk about the duration, convexity, and maturity of the bonds. So that is something a different, entirely different topic and a bit long topic. But these like fixed maturity plans or your target maturity plans, where amount is locked in for a fixed period of time, and you get the uh, amount redeemed, and you also get a fixed rate of interest. So that is the one benefit of these plans. Okay. Then the selecting of debt funds. So we'll be like talking about the different types of debt funds, like more types of debt